Hello, my dear students. A very warm welcome to all of you in Shri Jayendra Rank Zone. I am your friend and mentor for the subject Business and Commercial Knowledge. In this lecture, we'll continue with Chapter 1 Business and Commercial Knowledge and Introduction. All the concepts will be covered in the coming series of lectures. So let us begin. This is lecture number 5. In the last lecture, we were doing the topic partnership. We'll be continuing with the partnership today. Just give heading. Just give heading. Types of partnership. Types of partnership. In the last lecture, we have learned types of partners, and now we are continuing with types of partnership. Partnership. Partnership can be can be partnership can be classified on the basis of on the basis of two factors. Partnership can be classified on the basis of two factors: duration, duration and duration and liability. Duration and liability. On the basis of on the basis of duration on the basis of duration there can be there can be two types of there can be two types of partnerships. There can be two types of partnerships. Partnership at will and particular partnership and particular partnership. Particular partnership. On the basis of on the basis of liability on the basis of liability the two the two types of the two types of partnership include one with limited liability limited liability and the other one with unlimited unlimited liability. These types are described as follows. Classification classification on the basis of duration. Classification on the basis of duration. First, partnership. Partnership at will. Partnership at will. This type of this this type of this type of partnership exists. This type of partnership exists at the will at the will of the partners at the will of the partners. It can continue it can continue as long as the the partners want and is terminated and is terminated when when any partner gives a notice of notice of withdrawal from from partnership to the firm. Partnership to the firm. Partnership to the firm. Next is particular partnership. Particular particular partnership. Partnership formed partnership formed for the accomplishment for the partnership formed for the accomplishment of a of a particular project, say construction construction of a building construction of a building or an activity or an activity to be carried on to be carried on for a for a specified time period for a specified time period is called particular particular partnership is called particular partnership. It dissolve it dissolve automatically it dissolve automatically it dissolve automatically when the purpose for which when the purpose for which it was formed it was formed is fulfilled or or when the time when the time duration expires, when the time duration expires. Next is classification. Classification on the basis of on the basis of liability. Classification on the basis of liability. First is general partnership. First is general partnership. In general, in general partnership, in general partnership, the liability of the liability of partners the liability of partners is is unlimited and joint. The liability of partners is unlimited and joint. The partners the partners enjoy the partners enjoy the right to participate the right to participate in the right to participate in the management in the management of the firm and 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 their acts are and their acts are binding on each other each other as well as on the firm as well as on the firm. Registration of the firm registration of the firm is optional. In a partnership concern, registration of the firm is optional. The existence of the firm the existence of the firm is affected the existence of the firm is affected by the death the existence of the firm is affected by the death, lunacy, insolvency or retirement of the partners retirement of the partners. Next is limited partnership. Limited partnership. In limited partnership, in limited partnership, in limited partnership, the liability of at least one partner, the liability of at least one partner is unlimited, whereas 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 the rest may have the rest may have limited liability. The rest may have limited liability. The rest may have limited liability. Such a partnership, such a partnership does not get terminated, does not get terminated with the death, with the death, lunacy, lunacy, or insolvency, insolvency of partners, insolvency of the partners, the limited partners, insolvency of the limited partners, limited partners. The the limited partners, the limited partners do not enjoy, the limited partners do not enjoy the right of, do not enjoy the right of management, the right of management, and and their acts and their acts do not bind, and their acts do not bind the firm, do not bind the firm, or or the other partners, do not bind the firms or other partners. Registration, registration of such partnership, registration of such partnership is compulsory. Registration of such partnership is compulsory. This form, this form, this form of partnership was not permitted, was not permitted in India earlier. In India earlier, not permitted India earlier. The permission, the permission to form partnership, the permission to form partnership firms, firms with limited liability, with limited liability has been granted, has been granted after 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 introduction of new small enterprise, new small enterprise policy, Small Enterprise Policy in 1991. The idea, the idea behind such a move, the idea behind such a move has been has been to enable the partnership firm to enable the partnership firm enable the partnership firm to attract equity capital from friends friends and relatives from of friends and relatives of small scale enterprises. So small scale enterprises who were who were who was earlier reluctant who was earlier reluctant to help due to the existence of unlimited liability clause in the partnership in the in the partnership form of business in the partnership form of business. I believe you understood this. I believe you understood. So limited partnership. In limited partnership, the liability of at least one partner is unlimited, whereas the rest may have limited liability. Such a partnership does not get terminated with the death, lunacy, or insolvency of limited partners. The limited partner do not enjoy the right of management and their act do not bind the firm or any other partners. Registration of such partnership is compulsory. This form of partnership was not permitted in India earlier, but the permission to form partnership firms with limited liability has been granted after introduction of small enterprise policy in 1991. The idea behind such a move has been to enable the partnership firms to attract equity capital from friends and relatives of small scale enterprises who were earlier reluctant to help due to the existence of unlimited liability in the partnership form of business. The next the next topic in partnership is partnership deed. Partnership deed means partnership agreement means partnership agreement. A partnership is a voluntary association. A partnership is a voluntary association of people of people who come together who come together for for achieving common objectives achieving common objectives common objectives. In order to enter, in order to enter into partnership, in order to enter into partnership, a clear agreement, a clear agreement with respect to, a clear agreement with respect to the terms, with respect to the terms, conditions, terms, conditions, and all aspects, and all aspects concerning, concerning concerning the partners is essential. The partners is essential so that there is there is no misunderstanding, no misunderstanding, there is no misunderstanding later, later among the partners, later among the partners. Such an agreement, such an agreement can be oral or written. Such an agreement can be oral or written. Such an agreement may be oral or written. Even though, even though it is not essential, even though it is not essential to have a written agreement, to have a written agreement, as it constitutes, as it constitutes an evidence, an evidence, an evidence of the, an evidence of the conditions, an evidence of the conditions agreed upon, agreed upon, the written, the written agreement, the written agreement which specifies, the written agreement which specifies the terms and conditions, and terms and conditions that govern, that govern the partnership, that govern the partnership is called the partnership deed, is called the partnership deed. The partnership deed generally, the partnership deed generally includes generally includes the following aspects. The following aspects: name of firm, nature of business, and location of business, duration of business, investment, investment made by investment made by each partner, distribution of profits, distribution of profits and losses, distribution of profits and losses, duties and duties and obligations of the partners, duties and obligations of the partners, salaries and salaries and withdrawals of the partners, salaries and withdrawals of the partners, terms governing terms governing admission, terms governing admission, retirement and and exclusion, admission, retirement and expulsion of a partner, expulsion of a partner, interest on interest on capital and interest on drawings, interest on capitals and interest on drawings, procedure procedure for dissolution, procedure for dissolution of the firm, procedure for dissolution of the firm, preparation of accounts and and their auditing, preparation of accounts and their auditing, method of solving disputes, method of solving disputes, method of solving disputes. I believe you understood this. So this was about the partnership deed. So this explanation was about the partnership deed. The next topic is registration. 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 Registration of a partnership. Registration of a partnership firm. Registration of a partnership firm means the the entering of the firm's name along along with the relevant prescribed relevant prescribed particulars prescribed particulars in the register in the register of firms kept with kept with registrar of firms kept with registrar of firms. It provides it provides it provides conclusive proof it provides conclusive proof of the it provides conclusive proof of the existence of a partnership firm existence of a partnership firm. It is it is optional it is optional for a partnership firm it is optional for a partnership firm to get registered to get registered in case of in case of firm does not get registered in case of firm does not get registered it is deprived of it is deprived of many benefits it is deprived of many benefits the the consequences of non-registration the consequences of non-registration of a firm non-registration of a firm are as follows are as follows a partner of an unregistered firm a partner of an unregistered firm cannot file a partner of an unregistered firm cannot file a suit means case cannot file a suit against against the firm or other partners or other partners or other partners. B. The firm cannot file the firm cannot file a suit against third parties, third parties, against third parties, and and the firm the firm cannot file the firm cannot file a case the firm cannot file a case against against the partners cannot file a case against the partners. I believe you understood this. I believe you understood this. In view of in view of these consequences, in view of these consequences, it is therefore it is therefore advisable it is therefore advisable to get the firm registered to get the firm registered according to according to the Indian Partnership Act according to the Indian Partnership Act 1932. the partners the partners may get the partners may get the firm the partners may get the firm registered the partner may get the firm registered with the registrar of firms registrar of firms of the state registrar of firms of the state in which the firm is situated in which the firm is situated in which the firm is situated the the registration the registration can be the registration can be at the time of formation the registration can be at the time of formation or at any time or at any time during its existence or at any time during its existence the procedure the procedure for the procedure for getting a firm registered the procedure form for getting a firm registered is as follows is as follows first first submission of application in the submission of application in the prescribed form to the registrar of firms, to the registrar of firms, to the registrar of firms. The application should the application should contain the following particulars. The application should contain the following particulars. Name of the firm should be there in the application form. Location, location of the firm, location of the firm. Names of other places, names of other places where the names of other places where the firm carries where the firm carries on business carries on business. The date the date the date when each partner the date when each partner joined the firm, the date when each partner joined the firm. Names and addresses names and addresses of the partners addresses of the partners. Duration of partnerships duration of partnership. The next is the application the application should be signed by the partners. The application should be signed by the partners. The application should be signed by all the partners. This application should be signed by all the partners. So first point was submission of application. Right, the second point, deposit of required fees. Deposit of required fees with the registrar of firms. With the registrar of firms. Deposit of required fees with the registrar of firms. The third one, the registrar the registrar after approval the registrar after approval will make after approval will make an entry will make an entry will make an entry in the register will make an entry in the register of firms register of firms and and will subsequently and will subsequently issue and will subsequently issue a a certificate of registration a certificate of registration. So this was the registration process. Submission of application in a prescribed form to the registrar of firms. The application should contain the following particulars: details: name of the firm, location of the firm, name of other places where the firm carries the business, the date when each partner joined the firm, name and addresses of the partners, duration of the partnership. This application should be signed by all the partners. Deposit a required fees with the registrar of firms, and the registrar, after approval, will make an entry in the register of firms and subsequently issue a certificate of registration. I believe you understood. I believe you understood this. The next topic is LLP. The next topic is LLP, Limited Liability Partnership. LLP, Limited Liability Partnership. Drawing on its name, LLP form of business organization is the one where the liability of the partners are limited. However, there is much more in this form. It is to be mandatorily incorporated and registered under the Limited Liability Partnership Act 2009. A Ministry of Corporate Affairs, the apex body of regulation of company form of business organization in India, oversees the governance oversees the governance of the LLP too. For the purpose of compliance with the regulations thus imposed, the LLP Act provides for designated partners. Upon incorporation, LLP becomes a separate legal entity and has an identity, name and identification number, as well as life of its own, much the same way as perpetual succession of the company. The features of mandatory incorporation and separate legal entity of the LLP make it a hybrid form of business organization, that is, containing the features of both corporate form as well as proprietary form of business organization. These two features do away with the twin limitations of the traditional partnership, with unlimited liability and uncertainty as the going concern. Let's see the detailed features of LLP. Features: limited liability, no personal liability of partner except in case of fraud. If the partners are indulged in a fraud, in that case, they have personal liability which is involved. Incorporation, that is registration, is mandatory on them. It is a legal entity separate from the partners. It is a legal entity separate from the partners. That means business is not equal to businessmen. Business is having a separate legal entity is not equal to businessmen. It has separate legal entity. It has separate legal entity. Comparison with traditional partnership. Unlimited personal liability of each partner for dues of the partnership firm. Personal assets of each partners are also liable. So this is an example of the normal partnership or general partnership. Partnership is registered under the Partnership Act. Registration is not mandatory at all. The general partnership, the registration is not mandatory, but it is advisable. But In case of LLP, registration is mandatory. Incorporation is mandatory. Not a legal entity separate from its partners. Business equal to businessman. Or the partners constitute the partnership firm. Next is whether, merit or limitation, and how. The first, merit. This does away with a major limitation of traditional partnership. Next is merit. The mandatory registration brings the firm under the regulatory purview of the Ministry of Corporate Affairs, MCA. This increases the credibility of LLP. Merit. This does not away with the uncertainty of the firm's existence as a going concern. Let us continue. Let us continue. Let us continue with the features. Minimum 2 and maximum no limit on the maximum number of partners. Features. ROC is the administrating authority, registrar of companies. Registrar of companies is the administrating authority. Statutory compliances needs to be made. Every partner of LLP is only agent of firm. Every partner of LLP is only agent of firm. Let's see the comparison between the traditional partnership. In traditional partnership, minimum 2 and there is a maximum limit of 20 partners. In traditional partnership, the registrar of firms, ROF, of the respective states is the administering authority. Statutory compliances, not many. So there is not much statutory compliances in case of traditional partnership. And every partner of firm is agent of firm and also the other partners. So every partner is an agent of the firm and the other partners. Merit. The upper limit of the traditional partnership restricts the scope of business and future expansion plan because the upper limit is 20. Maximum there could be only 20 partners. But in case of LLP, there is no limit on maximum number of partners. Let us see the merits. So there is a body to control that brings credibility in the eyes of the stakeholder. There is a body to control that brings credibility in the eyes of the stakeholder, and that is Ministry of Corporate Affairs. Ministry of Corporate Affairs. I believe you understood. I believe you understood till here. Let us see limitation. Designated partners to ensure the compliance. However, in comparison with the companies, the compliance are fewer and simpler. Merit. Absence of mutual agency enhances freedom at one hand and on the other hand frees the other partners of the burden of responsibility of the acts of the other. So the agent concept, the partners, every partner is an agent of the firm and the other partner is not there in case of LLP. Do it again. Absence of mutual agency enhances the freedom of one hand and on the other hand frees the other partners of the burden, the responsibility of acts of the partners. I believe you understood till here. I believe you understood till here. Let's continue. The next form of business is company. Company form of business. It is also known as joint stock company. Joint stock company. It is also known as joint stock company. Company form of business organization. Company form of business organization. Company form of business organization is the flag bearer of corporate businesses. Company indeed is a corporate Company indeed is a corporate body having an existence independent of all its items, all its members. It existed in the contemplation of law, has a distinct name, address, that is registered office, and identification number. The word company, literally an association of two or more persons. However, as a legal artifact, there can be even a one person in India wide the Companies Act 2013. So OPC is also allowed under the Indian Companies Act 2013. It is still in a status, yet it is being hailed as a likely catalyst in unleashing the entrepreneurial spirit in India. Recall that we posited sole proprietorship as a hallmark of entrepreneurship. OPC is likely to be its corporate form. In addition, the Companies Act 2013 also provides for the incorporation of a small company in acknowledgement of the role of small scale enterprises in India. Interestingly, the Act also provides for incorporation of a dormant company that may be created for a future project or to hold an asset or intellectual property and has no significant accounting transactions. We shall, for the purpose of this chapter, however, restrict to the discussion of private and public companies only to highlight the features of corporate form of business organizations. We are already aware of the ideas of independent legal existence, limited liability, and separation of ownership from management. We have also seen how a corporate status instills credibility and trust among the business associates. Let us emphasize how the idea of a joint stock company led to mobilization of a large amount of capital directly from the savers by issuing of shares. A share is a share, that is a portion of the capital of the company, in smaller denominations. In fact, capital market is developed and the ownership of productive assets of the economy is democratized. Albeit this remains an ideal to aspire, as in practice the ownership of many public companies in India and other Asian countries is highly concentrated among few hands or very few promoters. Let us continue. In order to make the system of diffused ownership diffused ownership of the joint stock companies and their management work, an elaborated system of corporate functioning and the regulation of capital market has to be in place. The Companies Act 2013 focuses on the former focuses on the former and the Securities Exchange Board of India Act 1992, SEBI Act 1992 focuses on the latter. A company has to be A company has to file a memorandum of association, that is MOA, and article of association, that is AOA, along with application for incorporation. The MOA, among the other things, spell out the objectives of the company and its business. The AOA focuses on the internal regulation and internal management of the company. The company solicits the capital contribution by issue of prospectus. I believe you understand the meaning of prospectus. There are elaborate provisions in the Companies Act and the Securities Exchange Board of India Act 1992 to ensure that the prospectus contains such true and correct information as may enable the public to form an informed judgment on whether or not to invest in a company. A common man can avail the services of investment advisors in this regard. Then there is a requirement of statutory audit of the accounts of the company and publication of its quarterly results to keep the investors well informed. The SEBI also oversees the subsequent trading of the company, shares and contracts of listing by which the shares of a company are put up for trading on a stock exchange. The listing agreement, among other things, also enjoins upon the companies to carry on a business in an ethical, transparent, and accountable manner. I believe you understood till here. Let us continue. Public, Publicly traded, listed companies have to meet stringent criteria of both the Companies Act and the Securities Exchange Board of India, SEBI. This increases the cost of compliance. In contrast, private companies have lesser compliances to meet and have greater flexibility in their internal functioning. The law provides these privileges to the private companies because these are closely held and the owners have greater opportunity to exercise control over the management of these companies. There is little surprise that the Indian corporate sector is numerically dominated by private limited companies. In fact, the world over, there has been a distinct trend towards privatization of such public limited companies in view of growing cost of compliance. I believe it is clear till here. I believe it is clear. Features of private limited company and public limited company, a comparative study. Features of private limited company: minimum number of members could be 2, but in case of public limited company the minimum number of members are 7. Comparative assessment: lower number of minimum members, 2 eases of formation. That means the private limited company is easy to form because it has a lesser number, that is 2, as compared to a larger number, that is 7, in case of public limited companies. Maximum number of members 200 in case of private limited company. In case of public limited company, there is no upper limit of maximum number of members. No upper limit on the members of public company puts on its disposal enormous funds. That means a public limited company has more funds as compared to a private limited company. I believe it is clear. I believe it is clear to you. There are restrictions on the transfer of shares. The shares may be freely tradable on stock exchange via listing. So in case of public listed company, the shares could be freely tradable on stock exchange, Bombay Stock Exchange, BSE, National Stock Exchange, NSE. Listing of the shares of a public company adds to their liquidity so that the investors may encash the shares whenever needed. They'll be able to release the cash from the shares whenever the cash is required to the shareholders. Next, minimum number of directors in case of private limited company is 2 and minimum number of directors in case of a public limited company is 3. Not of much consequence, smaller board size adds to the internal efficiencies. Private companies are exempted to constituting such committees on the board of directors as Audit Committee, Corporate Social Responsibility Committee, CSR Committee, Stakeholder Committee, and the Nomination and Remuneration Committee. So private companies are exempted from forming these many committees. These committees are to be mandatorily constituted in case of public limited companies because the public welfare is at the core. More liberal a governance regimen of private companies exists because common man's money is not on stake in their share capital. So it's but obvious that the general public's money, the common man's funds are not invested in case of private limited companies. So they are not doing so. Basically, as per the law, they are not compulsory. It is not mandatory. It is not compulsory for them to form these many committees. But because the public has invested in a public limited companies, so CSR committee and stakeholder committees need to be formed. I believe you understood this. I believe you understood this. Next, it can start business upon incorporation. That means what? A public limited, a private limited can start its business upon its incorporation. That means a private limited company can start its operations by achieving certificate of incorporation. Certificate of incorporation. But in case of a public limited company, they could start operations after getting the certificate of commencement of business. A public limited company is required to obtain a certificate of commencement of business. Certificate of commencement of business in addition to certificate of incorporation. So after getting certificate of incorporation, the public limited company also required to get a more certificate, that is certificate of commencement of business, and after that only they can start the operations. Fewer formalities adds to the attractiveness of the private limited companies. More so, corporatization of proprietary concern, example, partnership firms, albeit now there is also an option for the partnership firm to convert into LLP. I believe you understood. I believe you understood this. Let us quickly refer what we have done in today's class. Let us quickly refer what we have done in today's class and then we'll wind up this session. So, in this class, we have continued with the types of partnership. We learned that partnership is basically divided between on the basis of two parts, that is classification. On the basis of duration, we have partnership at will and we have a particular partnership. Partnership on the classification on the basis of liability, we have general partnership and limited partnership. This limited form of partnership is also explained in detail, that is LLP, in the form of LLP. Partnership deed, that means agreement. These are the list. Basically, these lists is a part of the partnership agreement. Registration. So registration of a partnership is optional but not mandatory. The consequences of non-registration of a firm are as follows. The procedure for getting a firm's registration is as follows. So there are three steps. First, we need to submit the application form. Then the fees should be deposited, and at last, the registrar will approve after checking the documents. The next, we have started with LLP, Limited Liability Partnership. We have dealt in detail. We have seen the features of LLP, the merits of LLP, and a limitation of LLP also. At last, we have begun with the company form of business, that is joint stock company. We have seen the concepts of joint stock company in detail. We have tried to differentiate between the private limited company and a public limited company. We are stopping here. We are stopping here. We'll continue from here in the next class. Thank you. Thank you.